Thank you very much, Ben.
Cheers.
First of all, I'd just like to say thanks to Peter and the team at Switzer for the opportunity to present today, so thank you so much. Also, I just want to say to all the people that are still here today, thank you so much for coming along. I know it's been a long day, and thank you so much for holding on to the end, so thank you very much for that. Hopefully you received some great information today, and I'm hoping to add to that as well. So, Trilogy. Just a quick disclaimer, general nature only information today. So, Trilogy Funds, about Trilogy Funds. We're a boutique fund manager that actually works in or plays in the actual property market space. Our logo or our saying is that we know property. We were established back in 1998. The most important part of this is the fact that we are active managers, investment managers. So we actively manage each of the loans that we actually provide funding to. And I'll get into that a little bit further. Again, our investment offerings that I'll speak to you about today is income only. Again, very topical today, given the fact that we're in a low rate environment and the impending changes that may occur with the election that's about to happen could also have an impact, a detrimental impact on further yield for you guys. Last point, there's a strong reputation on skills and experience of our executive team. So just a quick point on that, I'll just make a little point on that. We have two offices, one in Sydney, one in Brisbane. The two executive directors out of the Sydney office are gentlemen by the name of John Barry and Roger Bacon. And those two gentlemen actually started the Challenger Fund in Australia back in the mid-80s. So they built that business to be the biggest mortgage fund, property syndicate business in Australia by the mid-90s. They had circa $3 billion worth of funds under management at that time. One of the directors on their board was Kerry Packer. And Kerry loved the business so much he actually bought it from both John and Roger. So those two gentlemen are extremely independently wealthy themselves. So Trilogy for them is like a hobby. So which means that they're not after a quick buck and they're very conservative in their approach, which is a great thing to be given the fact that we are dealing with investors' monies. What I'm quickly going to go to, and again, a lot of these points have already been litigated today, so I don't want to really touch on those in any great detail, given the fact you've already heard about it a number of times. I just want to point out some key points that you guys might need to know, or just emphasise once again. So, as James said earlier before, RBA cash rate at the moment is 1.5%, has remained at that level for the last 2 to 3 years. Just further to that point, and again it's already been discussed, and just quickly, we believe there'll be a further couple of rate reductions this year, where the official cash rate may fall to 1%. That's on the back of a fairly anemic inflation climate that we currently have here in Australia. Growth is subdued, again, due to the fact that the correction in the property market, particularly Sydney and Melbourne, and I'll actually drill down further into those particular property markets further. Inflation, last quarter, or this quarter just finished, 0%, well below the 2% band that the RBA follow. Again, what that means is the fact that the RBA will look to stimulate the economy through interest rate cuts, which is fairly likely. And the Australian dollar is actually falling as we speak as well, due to the fact that over the Fed in the US has actually increased rates. However, that's obviously now stopped for a little while. Just quickly, some charts here. As you can see, the GDP growth rate has come down on the back of really the correction in the property market here in Australia. Again, that inflation bandwidth, 2 to 3% is the actual threshold the RBA follow. Again, that's showing fairly anemic their returns or inflation rates, I should say. And the Australian dollar, as you can see, is actually trending down. Okay, big picture, global inflation this year, just briefly, remain benign. Volatility will remain high due to obviously ongoing political risk, particularly in the US. And key points I want to make, particularly around Australian economic climate and what we expect here. Australian growth expected to be subpar as housing downturn detracts the 1.5 percentage points off growth. The other key point, just to emphasise once again, interest rates are likely to fall. So they'll have an impact on those that rely on yield and looking for yield solutions. And again, that's where Trilogy can come in and actually help you with some of those solutions to those issues. So what I really want to drill down on today is really the property market across the eastern seaboard in particular. So what we've seen is that correction, particularly in Sydney and Melbourne, which has obviously had a major impact. Capital city dwellings have declined, whereas those in the regional areas have remained subdued, even though that's showing an increase. Recently, there's actually been a subdued effect on the regional areas as well. Where the correction has really occurred, particularly in Sydney and Melbourne, has been in those affluent areas, the likes of Toorak and Melbourne, here in the harbour areas. So it hasn't been across the board, even though the growth corridor areas such as the first home buy type market in the outer suburbs have remained fairly subdued and has been going sideways with a touch decline. The major decline has been in the affluent suburbs in particular. So again, there's been tightening bank lending standards, so that's obviously going to have a drag on the return outlook. And again, the Royal Commission on Banking, as we all know, has had an effect on lending for foreigners and also property development. So that's actually good for us, given the fact we're a non-bank lender, and that's provided us great opportunity in that space as well. Okay, just to drill down further into each particular capital city, as you can see there, Sydney's down 10.4 annually, Melbourne 9.1. Brisbane is 0.5. Again, Brisbane's just going sideways. I'll go a little bit further into that shortly. Again, really interesting point here is the median value of housing in Sydney. If you recall, prior to the correction, it was circa $1 million plus. Again, also prior to the correction, Sydney was actually growing at 19 to 20%, which is obviously unsustainable. Melbourne, in comparison, 629 at the minute. However, back before the correction, it was running at about 880,000. Again, 12 to 15% growth prior to the correction. Again, unsustainable. Okay, this is a little bit of a busy chart, but what I just want to emphasise here is this is a combined capitals versus combined regionals. As mentioned, this black line there is a combined capitals market performance. So it's been a fairly bigger correction than those of the regional areas, as mentioned earlier. So nationally, the 2.7% down, nationally combined regional as well as capital, whereas regionals is down 0.8%, so it's fairly subdued in terms of decline, whereas the capital is 3.3%. Okay, so as mentioned earlier, where the major correction has been in the affluent suburbs of both Sydney and Melbourne in particular, this chart actually shows this. This 10th decile here is actually those more affluent properties. That's been a larger decrease and declines than those over here, which are first home buyer type property markets. Those are the outer suburbs of both Sydney, Melbourne, Brisbane, etc. Okay, drilling down further into Sydney, which is obviously topical given the fact we are in Sydney here right now. So as you can see, the cyclical nature of property markets, back to 94 through to 19. Big picture here, 10.4% down for the year, 13.2% down from the highs in July 2017. So if they were running at 19 to 20% prior to the correction, that's a fairly sustainable correction. It's been a soft landing per se, which is a good thing. A little bit further drilling down, 10.4 as I said, 12 months. However, that's juxtaposed against the average annual growth in the past decade of 5.7%. The other point here that I just want to make is the gross rental yield on property. That's gross. If you take in holding costs, etc., that comes in quite a bit. So the return rental yield is fairly low. Okay, Melbourne. So very similar to Sydney, those cyclical nature of property in Melbourne. And again, that's come off 9.1% in the last 12 months, 9.6% from the peak in November 2017. And again, just to drill down a little bit further, those corrections juxtaposed against the annual growth of the past decade of 5.4%. And that's the gross rental yield in Melbourne as well. Okay, Brisbane market. As you can see here, not as cyclical as Sydney and Melbourne, and certainly since 2015, it's remained fairly sideways moving. So not much has been happening in Brisbane, as is borne by this. Last year's been down 0.5% and down 1% since the peak. And again, just drill down a bit further, this one here is a little bit different. As you can see, 1.6% as opposed to the 5s and the 4s and 3s for Sydney and Melbourne. Again, higher gross rental yield here as well in Brisbane. Okay, key takeaways. So I'll just make an emphasis on Sydney in particular and just cover briefly on Melbourne and Brisbane. Okay, Sydney. So there's been a larger decline in the value of houses than apartments. And again, as I mentioned to you earlier, more declines and corrections in those more affluent suburbs. So as I mentioned as well, it's actually been the dwelling values have surged in Sydney, circa 80% since the beginning of the last property cycle. So 2012, through the correction, they were surging and has growth of 80%. So again, this correction that we've seen in the last 12 or so months is fairly sustainable in light of that. One key point here that I just want to make mention is that first home buyers are active in Sydney, which is great. It creates stronger markets at a lower quarter of the market, particularly lower end first home buyer type stock. Okay, now Sydney market is likely to remain weak for the first half of this year. Now, due to the oversupply of new apartments, etc. However, we're likely to pick up in the second half of the year after the election, depending on obviously what happens. Now, just briefly on Melbourne and Brisbane. Melbourne market is fragmented, the property market is fragmented. So some areas are doing well, whereas others are not. And again, values are underpinned by population growth. One thing, the demographers recently have actually said that Melbourne, in the next 10 to 15 years, could very well be the most populated capital city in Australia. It's actually, as it says there, one of the 10 fastest growing large cities in the developing world, which is great for the property market moving forward. Brisbane. Now, Brisbane's an interesting one because obviously, as you noticed with the graphing that we had there, it was really just going sideways. Now, we will not see any of those large declines that we've seen in Sydney, Melbourne and Brisbane due to the fact that it has remained fairly subdued. However, we're of the belief that Brisbane's on the cusp of a fairly strong growth period in the property market. And that's underpinned by a couple of reasons. One of the reasons is certainly also the fact that it's affordable and livable, meaning people are moving to Brisbane or South East Queensland for livability reasons. You know, sunny weather in winter, etc., etc. The second point is affordability. As you noticed, Sydney and Melbourne are a lot higher in terms of property prices, whereas Brisbane is circa $450,000 medium house value. So what we're seeing, the phenomenon we're seeing is people selling up in Sydney and Melbourne and moving to Brisbane. And again, net migration figures into South East Queensland is positive 1.6%, which is the highest since 2003. So these are all great reasons why we believe the Brisbane property market is on a cusp of a good growth period. I won't go through Adelaide, the other cities. Now, net migration, as you can see here, that's the Brisbane line there, so you can see it's improving. That's Melbourne, and this is Sydney down here, or New South Wales, I should say. Just quickly, briefly, population growth is obviously housing demand is important. It's certainly trending upwards on the back of really net overseas migration, which is trending up, whereas the natural increase, that's births versus deaths, has remained fairly static there. I just want to put this chart in here just for interest purposes. It's the fact that the impact of lending changes. So as you know, a couple of years ago, when the property cycle was certainly overheating in Sydney and Melbourne, APRA, which is the Prudential Authority over the banks, made some regulation changes. And as a result, they've had some major impacts, and these charts certainly show those impacts. So this one first here is percentage of mortgages originated on interest-only terms. So that's obviously taken the heat out of the investment market coming in and purchasing investment properties. So prior to the correction, it was running at 45.6. That's just gone over a cliff in terms of interest-only terms. Here, owner-occupied versus investor. The blue line there is the owner-occupied. As you can see here, prior to the correction, it was actually the other way around. Now it's flipped the other way, whereas the investor space is now fairly subdued. And the LVRs, so this is a chart that shows percentage of mortgages settled with an LVR 80% plus, and that's declined markedly since the correction. Okay, I just want to talk about our particular income funds. So our Trilogy Monthly Income Trust Fund is our flagship fund in existence for 12 plus years. Last month we averaged rate of return of 7.7% per annum, which is net of fees. Since inception, 7.84%, which is a fairly compelling headline rate given the fact that we play in that alternative fixed interest space. And again, people are chasing yield at the moment. Just an interesting graph here. So this is the Trilogy Monthly Income Trust rate of return over a period of time, and this is the cash rate. So we're obviously outperforming that quite markedly. And see through here, fairly regular income is fairly stable. And our other particular investment offering for income is the Trilogy Enhanced Cash Fund. This is 7-day cash at call. Last month we returned 4.86% per annum return, which is a fairly sharp rate for a 7-day cash at call account. It gives you the flexibility to be able to then withdraw your money after 7 days, essentially. And that's net of fees as well. With both products, just so you know, is that we actually pay monthly distributions as well. And they're both liquid. And with that said, I'm finished. Thank you very much.